If you're a silver stacker, what I'm about to share with you might be the most important information you hear all year. Because right now, while most people are completely distracted by the noise in the markets, something extraordinary is happening in the silver market that very few people are talking about. And the stackers who understand what's coming are positioning themselves right now before the window closes. Let me ask you something. Have you noticed how hard it's become to find physical silver at reasonable premiums lately? I'm talking about walking into your local coin shop or checking online dealers and seeing premiums that would have seemed absolutely insane just a couple years ago. That's not an accident, that's not temporary, that's a symptom of something much bigger that's unfolding right beneath the surface. See, there's a disconnect happening in the silver market that defies everything we've been taught about how markets are supposed to work. On one side, you've got the paper price, the spot price you see quoted everywhere, the price that gets set on the COMEX in New York, where massive amounts of silver contracts trade hands every single day. But here's the thing. Most of those contracts never result in actual physical delivery. They're just bets on the price. Financial instruments, derivatives, paper promises, and then on the other side, you've got the physical market, the real metal, the coins, the bars, the actual silver that you can hold in your hand. And that market is telling a completely different story. Because while the paper price has been volatile, bouncing around, the physical market has been screaming one message loud and clear. There isn't enough to go around. Now, before we go any further, I want to make sure you have access to something I put together. It's a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now to safeguard their hard-earned savings. You'll find it in the description below. It's completely free, and if you're concerned about what's happening in the economy, in the markets, with inflation, it's worth checking out. But back to what's happening with silver. Let me paint you a picture of just how tight this market has become. The Silver Institute, which tracks global supply and demand, has been reporting deficits for years now. We're not talking small shortfalls. We're talking about hundreds of millions of ounces where industrial demand, investment demand, and jewelry demand are consuming more silver than the mines are producing. Year after year after year. Think about that for a second. Silver is being consumed faster than it's being pulled out of the ground. And unlike gold, which mostly just sits in vaults after it's mined, silver gets used up. It goes into solar panels that get installed on roofs. It goes into electronics that eventually end up in landfills. It goes into medical applications, into water purification systems, into batteries. The majority of silver that gets mined doesn't get recycled. It's gone, used, consumed. And here's where it gets really interesting. The industrial demand for silver isn't slowing down, it's accelerating. The push toward green energy, toward electric vehicles, toward more electronics, all of that requires silver. Lots of it. Every solar panel needs silver. Every electric vehicle uses significantly more silver than a traditional car. The 5G build-out, the expansion of electronics manufacturing, all of it is pulling on the same limited supply. But the mines aren't keeping up. In fact, many of the world's largest silver mines are seeing declining production. The easy silver has already been mined. What's left is deeper, harder to extract, more expensive to process. And with energy costs rising, with labor costs increasing, with environmental regulations getting stricter, it's not getting any easier or cheaper to pull silver out of the ground. So you've got this situation where demand is rising, supply is struggling, and the market is running a deficit. Economics 101 says that should push prices higher, right? Supply and demand, basic stuff. But the paper market has been keeping a lid on it. How? Through the sheer volume of paper contracts that trade on the COMEX. Contracts that represent far more silver than actually exists in the COMEX warehouses. Let me give you some context here. The COMEX warehouses hold a certain amount of physical silver, but the amount of silver that trades in paper contracts on any given day can be multiples of what's actually sitting in those vaults. It's like a game of musical chairs, where there are 100 people dancing around but only 10 chairs. As long as the music keeps playing, as long as most people are content to just trade the paper and not demand physical delivery, the game continues. But what happens when people start demanding the chairs? What happens when investors, when industrial users, when stackers like you start saying, I don't want the paper promise, I want the actual metal? That's when the system gets stressed. That's when premiums spike. That's when delivery delays start happening. That's when dealers run out of inventory. And we're seeing signs of that stress right now. Major dealers have been reporting allocation issues. Mints have been struggling to keep up with demand. The US Mint, the Royal Canadian Mint, the Perth Mint, they've all had periods where they couldn't produce enough coins to meet demand. And when supply is tight, premiums go up, way up. Now, I want to take you back in history for a moment because this isn't the first time we've seen a disconnect between paper and physical in the silver market. Back in the late 70s, the Hunt brothers tried to corner the silver market. They accumulated massive amounts of physical silver, and the price went absolutely parabolic. Silver went from around $6 an ounce to over $50 in just a couple of years. The Hunts understood something fundamental. There's only so much physical silver available, and if you can control enough of it, you can force the price higher. Now, the Hunts eventually got crushed because the COMEX changed the rules on them. They literally changed the trading rules mid-game to break the Hunt brothers. But here's what's different today. It's not one or two wealthy individuals trying to corner the market. It's millions of individual stackers around the world, all making the same decision independently. They're choosing to hold physical silver. They're taking it off the market. They're putting it in their safes, in their vaults, under their beds. And unlike the Hunts, you can't change the rules to stop millions of individuals from making personal decisions about how to protect their wealth. There's another historical parallel worth considering. In 2011, silver hit nearly $50 an ounce again. That wasn't because of a corner attempt. That was because of a perfect storm of factors. Quantitative easing, fears about the dollar, investment demand surging, and yes, supply concerns. But after that peak, silver got hammered. It fell all the way back down into the teens and stayed there for years. A lot of stackers who bought at the top got discouraged. They sold, they gave up. But the ones who understood the fundamentals, who understood that silver is real money, real wealth, they kept stacking, they kept accumulating. And now they're sitting on positions that have appreciated substantially because silver has been climbing again. Not in a straight line, never in a straight line, but the trend has been unmistakably higher. Here's something most people don't realize about silver. It's one of the most manipulated markets in the world. I'm not talking conspiracy theory stuff here. I'm talking about documented cases. Major banks have been fined hundreds of millions of dollars for spoofing the silver market, for placing fake orders to manipulate the price. This isn't speculation. This is settled legal fact. Banks have admitted to it. They've paid the fines. Why would they do that? Why would major financial institutions risk massive fines to manipulate the silver price? Because there are enormous short positions in silver, positions that would be catastrophically expensive to cover if silver were to rise significantly. So there's a vested interest in keeping the price suppressed, in keeping the paper price from reflecting the true supply and demand dynamics of the physical market. But here's the thing about manipulation. It can only last so long. Eventually, reality asserts itself. Eventually, the physical market overwhelms the paper market, and when that happens, the moves can be violent. We saw it in 2011. We saw it in 2020 when silver briefly spiked during the pandemic, and we're likely to see it again, potentially on an even larger scale, because the fundamentals have never been more bullish for silver. You've got the supply deficit, you've got rising industrial demand, you've got investment demand from stackers who understand what's happening. You've got central banks around the world printing money like there's no tomorrow, which makes hard assets like silver more attractive. You've got geopolitical tensions that are driving people towards safe haven assets. You've got the potential for a major short squeeze if enough people demand physical delivery. And here's something that should really get your attention: the gold to silver ratio. Historically, this ratio has averaged somewhere around 15 to 1 or 20 to 1. Meaning it took 15 or 20 ounces of silver to buy 1 ounce of gold. But in recent years, that ratio has been much higher. There have been times when it took 80 or even 100 ounces of silver to buy 1 ounce of gold. Right now, even with silver's recent gains, the ratio is still elevated compared to historical norms. What does that tell you? It tells you that silver is undervalued relative to gold. And when that ratio starts to compress, when silver starts catching up to gold, the moves can be explosive. Because silver is a much smaller market than gold. It doesn't take as much money flowing in to move the price significantly. Let me give you a sense of scale here. The entire above-ground supply of investment-grade silver, all the coins and bars that exist in the world, is worth a fraction of what some individual tech companies are worth. The entire silver market is tiny compared to the bond market, the stock market, even the gold market. So when money starts flowing into silver, when investors start allocating even a small percentage of their portfolios to physical silver, it can have an outsized impact on the price. And that's exactly what we're starting to see. Retail investors are stacking. Institutional investors are taking notice. Even some countries are looking at silver as a strategic resource. Because silver isn't just a monetary metal. It's an industrial metal that's critical for modern technology. It's essential for the green energy transition. It's irreplaceable in many applications. Now let me talk about something that's crucial for anyone who's thinking about their financial future, especially if you're approaching retirement or already retired. The traditional 60-40 portfolio, stocks and bonds, that model is being challenged like never before. Bonds aren't providing the safety they used to when interest rates are volatile and inflation is eating away at purchasing power. Stocks are at valuations that make a lot of people nervous. Real estate is expensive in most markets. Where do you turn for real diversification? Where do you turn for an asset that isn't someone else's liability? That's where physical precious metals come in. And specifically, that's where silver comes in. Because silver gives you exposure to both the monetary side and the industrial side. It's a hedge against currency debasement and a play on technological advancement at the same time. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers how you can get physical precious metals into your retirement account without triggering tax penalties, how to protect your wealth from market volatility, from currency devaluation, from the kind of systemic risks we're seeing build up in the financial system. It's worth checking out if you're looking for ways to diversify and protect what you've worked your whole life to build. But back to the silver market and why stackers need to be paying attention right now. One of the most important things to understand is the difference between price and value. Price is what you pay, value is what you get. And right now, there's a strong argument that silver's price doesn't reflect its true value. Think about what silver represents. It's a tangible asset with thousands of years of history as money. It's a critical industrial metal that's essential for modern life. It's in limited supply with production struggling to keep up with demand. It's being consumed and not recycled in many applications. It's held by millions of individuals around the world who view it as wealth preservation. And yet, the paper price is still being influenced by trading on exchanges where most participants never take delivery of physical metal. That disconnect creates opportunity. For stackers who understand what's happening, who are willing to look past the short-term volatility and focus on the long-term fundamentals, this is a moment to be paying very close attention. Let me tell you about what's happening in the physical market right now. Dealers are reporting that when silver dips, they get flooded with buy orders. People are stacking on the dips. They're accumulating. They're taking advantage of any weakness in the paper price to add to their physical holdings. And when that physical metal gets bought and put away in private hands, it's not coming back to the market easily. It's being held. It's being stacked. This is creating a one-way flow. Silver is moving from the COMEX warehouses, from the dealer inventories, into private hands. And it's not flowing back because the people who are buying physical silver right now, they're not traders. They're not looking to flip it for a quick profit. They're stackers. They're holders. They understand that silver is real money, real wealth, and they're accumulating it as a long-term store of value. And here's what makes this so powerful. Every ounce that moves into strong hands, into the hands of stackers who aren't going to sell, that's one less ounce available for industrial users who need it. That's one less ounce available for investors who might want it later. That's one less ounce that can be used to satisfy delivery demands on the COMEX. The COMEX system works on the assumption that most people won't take delivery, that they'll just roll their contracts or settle in cash. But what happens when more and more people start demanding physical? What happens when industrial users who need silver for production can't get it from the usual sources and start demanding delivery on their futures contracts? What happens when the ratio of paper claims to physical metal gets so stretched that confidence in the system starts to crack? We've seen glimpses of this. We saw it in 2020 when the pandemic disrupted supply chains, and premiums on physical silver exploded. We saw it during the Reddit-driven silver squeeze attempt when retail investors tried to coordinate buying physical silver, and certain products became almost impossible to find. The system is more fragile than most people realize, and it's not just retail investors who are noticing. There are reports of large institutional buyers accumulating physical silver, quietly, without fanfare, because they understand the same fundamentals that stackers understand. They see the supply deficit, they see the industrial demand growth, they see the potential for the paper market to lose credibility, and they're positioning accordingly. Now let's talk about what could be the catalyst that really breaks this market open. There are several possibilities. It could be a major industrial user deciding they need to secure long-term supply and making a massive physical purchase. It could be a country deciding to add silver to their strategic reserves. It could be a continued loss of confidence in fiat currencies driving more investment demand. It could be a short squeeze if enough longs demand delivery and the shorts can't cover. Or it could be something we're not even thinking about yet. Markets have a way of surprising us, but the setup is there. The fundamentals are there. The supply and demand imbalance is there. The question isn't if something is going to give. The question is when and how dramatic it's going to be when it does. For stackers, this means staying focused on accumulation. It means not getting shaken out by short-term volatility. It means understanding that the paper price might not reflect the true value of the physical metal you're holding. It means being patient, but also being aware that windows of opportunity don't stay open forever. Because here's the reality. If silver does what many stackers believe it's going to do, if it does start to reflect the true supply and demand fundamentals, if the paper market loses its grip on price discovery, the moves could be fast and dramatic. And at that point, physical metal might become very difficult to acquire at any price. We've seen it before in other markets. When everyone wants in at the same time, when panic buying sets in, premiums go through the roof and availability disappears. That's why stackers stack now. Not when silver is making headlines, not when everyone is talking about it, but now, when there's still physical metal available at premiums that, while elevated, are still reasonable compared to what they could be in a real shortage scenario. Let me share something else that's important to understand. Silver isn't just about making money. It's about preserving wealth. It's about having something tangible in a world where so much of our wealth exists as digital entries in computer systems. It's about having a form of money that can't be printed, that can't be devalued by central bank policy, that has intrinsic value because of its unique properties and its industrial uses. Throughout history, when fiat currencies have failed, and they always eventually fail, people have turned to precious metals. Gold and silver have been money for thousands of years across every civilization. That's not an accident. That's because they have properties that make them ideal for storing and transferring value. They're durable, divisible, portable, fungible, and scarce. And in today's world, where we're seeing unprecedented levels of debt, unprecedented money printing, unprecedented financial engineering, the case for holding some of your wealth in physical precious metals has never been stronger. Not as your entire portfolio, but as a meaningful allocation that provides real diversification and real protection. Silver specifically offers something unique. It's affordable enough that regular people can accumulate meaningful amounts. Unlike gold, where a single ounce costs thousands of dollars, silver allows you to build a position over time with smaller purchases. You can dollar cost average into silver. You can stack consistently. You can build real wealth in physical form without needing massive amounts of capital up front. And for those who understand the gold to silver ratio, silver offers the potential for outsized gains if that ratio compresses back toward historical norms. If silver catches up to gold on a relative basis, the percentage gains in silver could be substantially larger than in gold. That's the leverage that silver offers. But it's not without volatility. Silver can be a wild ride. It can swing dramatically in both directions. That's why it's so important to have a long-term perspective. To understand that you're not trading silver, you're stacking it. You're accumulating it as a store of value, as a hedge, as a form of wealth that exists outside the traditional financial system. The stackers who do well are the ones who have conviction in the fundamentals, who understand why they're holding silver, who don't panic when the paper price dips, who see dips as buying opportunities, who stay focused on accumulation and don't get distracted by short-term noise. And right now, the fundamentals are as compelling as they've ever been. You've got the supply deficit that's been running for years and shows no signs of reversing. You've got industrial demand that's growing, not shrinking. You've got investment demand from stackers around the world. You've got a paper market that's increasingly disconnected from physical reality. You've got geopolitical uncertainty. You've got currency debasement. You've got all the ingredients for a major move in silver. The question every stacker needs to ask themselves is this: am I positioned for what's coming? Do I have enough physical silver to protect my wealth if the scenarios we're discussing actually play out? Am I taking advantage of this window while physical metal is still available at reasonable premiums? Because history shows us that these windows don't last forever. There are times when silver is readily available and times when it's not. There are times when premiums are reasonable and times when they're not. There are times when you can accumulate at your own pace and times when you wish you had accumulated more when you had the chance. We're in a unique moment right now. The fundamentals are screaming one thing while the paper price is saying something else. That disconnect won't last forever. At some point, reality asserts itself. At some point, the physical market overwhelms the paper market. At some point, price discovery shifts from the futures exchanges to the physical market where real metal changes hands. And when that happens, the stackers who positioned themselves ahead of time, who understood what was coming, who had the conviction to accumulate when others were skeptical, those are the ones who will be glad they did. Now, before we wrap up, I want to make sure you take advantage of the resources I've put together for you. If you've watched this far, you're clearly serious about understanding what's happening in the silver market and how to protect your wealth. In the description below, you'll find that free guide I mentioned. But here's something extra for those who've stuck with me to the end. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. Completely free, no obligation, just a chance to have a real conversation about your specific situation and how precious metals might fit into your wealth protection strategy. This is only available to those who meet those criteria and who mention they watched to the end, so make sure you do that when you reach out. The bottom line is this: if you're a silver stacker, you need to be paying attention right now. The market is setting up for something significant. The fundamentals have never been more bullish. The disconnect between paper and physical has never been more obvious, and the window to accumulate physical metal at reasonable premiums won't stay open forever. This isn't about getting rich quick. This is about protecting what you have. This is about having real wealth in a world of paper promises. This is about being positioned for a future where the value of tangible assets becomes increasingly clear as the fragility of the financial system becomes increasingly apparent. So keep stacking. Stay focused on the fundamentals. Don't get shaken out by volatility. And understand that every ounce you put away is an ounce of real wealth that can't be printed, can't be devalued, and can't disappear with the click of a mouse. That's the power of physical silver. That's why stackers stack. And that's why right now might be one of the most important times to be doing exactly that.